Welcome to this explainer. A lot of people think accounting is just boring math, but it's absolutely not. It's actually the language of business. Today, we're going to learn this language by following the story of Alex, who is starting a brand new business, Alex's Cookie Kingdom. By the end of our time together, you'll see how every batch of cookies tells a distinct financial story. And, more importantly, you'll be able to read the story of any business by understanding the words they use to keep score. Okay, let's dive into this. Here is our structured roadmap covering the entire accounting ecosystem. First, we'll look at the accounting building blocks. 2, the rules of the game. 3, cash versus accrual basis. 4, the financial scorecards. And finally, 5, audits and accountability. Let's jump right in. Section 1, the accounting building blocks. Because before Alex can bake a single cookie, we have to actually know what we are measuring. You can't understand the score without knowing the pieces. Now, what's really interesting about this slide is how everything of value a company owns starts exactly here. An asset is an economic resource that is expected to be of benefit in the future. So for Alex's Cookie Kingdom, this isn't just the cash sitting in the register. We're talking about the industrial oven, the massive bags of chocolate chips waiting in the pantry, and even Alex's super secret cookie recipe. If it brings a probable future benefit to the business, it's an asset. But as you know, starting a business costs money. That brings us to liabilities. A liability is simply the formal term for what a business owes to others. It's a debt. So if Alex borrows $500 from their parents to buy that oven, or owes the local grocery store for a giant order of flour, that's a liability. In this scenario, Alex is the debtor and the parents or grocery store are the creditors. So the crucial point is, what does Alex actually own free and clear? Well, that's called equity. It's the residual interest in the assets of an entity that remains after deducting its liabilities. Think of it like this. If Alex sold the oven and all the leftover cookies tomorrow and used that cash to pay back the $500 loan from the parents, whatever cash is literally left over in Alex's pocket is the equity. It's the true leftover value of the business that belongs to the owner once all debts are paid. Put it all together and you get the absolute bedrock of business. Assets minus liabilities equals equity. What Alex owns minus what Alex owes equals what the Cookie Kingdom is actually worth. It's a simple equation, but every single financial decision a company makes ultimately impacts this balance. Section 2, the rules of the game. Now that we have our building blocks established, we need some strict rules for how to track all those ovens and loans. And this brilliantly illustrates the most important rule of all, double entry bookkeeping. This is a method where each transaction is entered in 2 or more accounts, and total debits must equal total credits. Basically, every financial action has an equal and opposite reaction. If Alex takes $50 in cash to buy sugar, the asset of inventory goes up, but the asset of cash goes down. Debits and credits must always match to keep the books completely balanced. This process feeds right into the accounting cycle. First, you measure the business transactions. Then, you transform those measurements into financial statements for a specific period. You don't just guess how much money you made at the end of the month. You methodically measure every single cookie sold and ingredient bought and turn that raw daily data into readable reports. It's exactly like turning raw ingredients into a finished dessert. While transforming that data, Alex has to follow the matching principle. This principle requires you to match reported revenue with the expenses it took to generate that revenue in the exact same time period. Why does this matter? Well, it prevents companies from hiding costs in different years to artificially inflate their success. You can't buy a year's worth of flour today, ignore the cost, and make yourself look super profitable this week. You have to match the cost of the flour to the specific cookies you sold today. Section 3, cash versus accrual basis. Now we're looking at the 2 main lenses through which a business can actually choose to record its financial realities. With accounting, timing is literally everything. Under the cash basis, a transaction is recorded only when cash is received or paid. You physically hand over $1, Alex writes it down. But under the accrual basis, revenue is recognized when it's earned and expenses when they're incurred. If Alex caters a massive school party on Friday, they record that revenue immediately, even if the school won't actually pay the invoice until next month. The timing of recording the transaction changes everything. Let's move to accrual and see how this builds on what we just learned. Accrual accounting perfectly utilizes the matching principle by recording financial effects when they occur, not just when cash moves. By tracking the finances when the cookies are actually earned or ingredients are used, Alex gets a much more honest and accurate picture of the Cookie Kingdom's true operational health. Section 4, the financial scorecards. So, how do we actually view the results of all this meticulous rule following? Let's take a look. The first major scorecard is the balance sheet. This is a basic statement presenting an entity's assets, liabilities, and equity on a specified date. Remember our Section 1 building blocks? This is just a snapshot of those 3 items frozen in time. It tells you exactly what the Cookie Kingdom owns, owes, and is worth at the exact stroke of midnight on, say, December 31st. Now, if the balance sheet is a photograph, the income statement is a motion picture. It's a summary of the effect of revenues and expenses over a period of time. It shows the real-time flow of money coming in and going out over an entire month or year of baking. At the very end of that income statement is the most famous phrase in all of business, the bottom line. This is the line that shows net income or loss. Did Alex actually make enough net income to expand the business, or did they suffer a net loss? All of that complex tracking, matching, and rule following ultimately boils down to this single, famous indicator of profitability. Section 5, Audits and Accountability. Here's the thing. Scorecards are only useful if we can actually trust the people keeping the score. The ultimate test of that accountability is the audit. An audit is a professional examination of a company's financial statement by a professional accountant to determine fair presentation. Imagine Alex wants a big bank loan. The bank won't just take Alex's word for it. They'll send an independent expert to double-check the math and ensure the business is telling the absolute truth to the public. When auditors check the books, they use GAAP, which stands for Generally Accepted Accounting Principles. The official definition is conventions, rules, and procedures necessary to define accepted accounting practice at a particular time. These are the strict standards auditors use, ensuring that Alex's Cookie Kingdom and a massive global tech company are speaking the exact same financial language. Sometimes during an audit, they'll find a material weakness. This is a significant deficiency where a material misstatement will not be prevented or detected. Basically, if Alex's internal controls fail, like forgetting to lock the cash register or losing half the receipts, a material weakness allows massive errors to easily slip into those critical financial scorecards without anyone noticing. But there's a huge difference between a disorganized, honest mistake and fraud. Fraud is the willful misrepresentation by one person of a fact, inflicting damage on another person. It's intentional. If Alex secretly pockets cash and deliberately alters the books to trick investors, that's fraud. It's an intentional attack on the integrity of the entire accounting ecosystem. So what happens to our economy when material weakness or fraud in the language of business goes unchecked? If we can't trust the scorecards, investors stop lending, and businesses everywhere simply grind to a halt. The rules and audits we explored today aren't just tedious math. They are the vital foundation of trust, keeping our society running. Thanks for joining me on this explainer, and I hope you can now read the story of business with absolute clarity. See you next time.